Let's dive right into this explainer and look under the hood of honestly one of the absolute most aggressive tools in modern finance. I mean, even if you never plan to day trade yourself, understanding this machinery is just crucial to navigating today's markets. Because today, we're not talking about your average, buy and hold retirement fund. We are looking at the intense mechanics of leveraged inverse ETFs. So, I want to start by asking you a question that kind of defines the very existence of our case study today. How do you bet against a stock? And actually not just bet against it, but do so with double the leverage. It sounds like something only a massive, highly capitalized hedge fund could pull off, right? Well, enter Tradr's 2x short AAOI Daily ETF. The ticker is AAOZ, and it is built to do exactly this for the common shares of Applied Optoelectronics. A 2x short daily ETF is a highly complex exchange-traded fund. It seeks daily investment results that correspond to, get this, negative 200% of its underlying stock's daily performance. Here is our roadmap for this explainer. First, the inverse leverage concept. Second, inside the AAOZ ETF. Third, the daily reset mechanism. Fourth, understanding the risks. And finally, rules for sophisticated traders. Okay, part 1. The inverse leverage concept. Let's look at the superpower this ETF claims to offer. The daily target for AAOZ is explicitly negative 200% of the underlying stock's performance. So what does this actually mean for you? If Applied Optoelectronics drops by 5% in a single trading day, this ETF is designed to gain 10% before fees and expenses. It magnifies the movement in the exact opposite direction. Basically, you're popping champagne while the stock takes a hit. Now, Tradr ETFs absolutely did not design these tools for ordinary long-term holds. These are built for investors looking for extraordinarily precise short-term exposure. We're talking day traders, swing traders, and professionals who want to implement really high-conviction views on specific companies. If you are absolutely certain a stock is about to take a quick hit, well, this is the precision instrument built for that exact thesis. Moving right along to part 2, let's look inside the AAOZ ETF. It's fascinating to look at the engine room of the ETF as of July 17, 2026, and see the literal financial plumbing making this work. They primarily use contracts for difference, or CFDs. Think of a CFD as an agreement to exchange the difference in a stock's price from the time a contract is opened to when it's closed, all without actually owning the underlying stock itself. To generate that massive inverse leverage, the fund's holdings show over 200% exposure in these synthetic derivatives, carefully balanced alongside cash assets. To maintain at least 80% exposure to financial instruments providing this leveraged inverse return, the fund managers have to actively manage this balance every single day. They pull this off utilizing complex derivatives. That can mean entering into swap agreements, which is essentially trading cash flows with another party, or purchasing listed options to bet on future price movements. It's a highly dynamic process that requires constant, active oversight. Which brings us to a really crucial point in part 3. The daily reset mechanism. The prospectus contains a warning that you absolutely must take literally. It says the fund does not seek to achieve its stated investment objective for a period of time different than a trading day. Let that sink in. It resets every single day. You cannot buy this ETF and expect that negative 200% math to hold up exactly over a week or a month or a year. It's kind of like a high-speed jet that is specifically designed to completely run out of fuel every single day at 4 p.m. This mechanism creates a continuous, relentless daily cycle of calculation and recalibration. Step 1, the ETF tracks the underlying shares during the trading hours. Step 2, after the market closes, which is ordinarily at 4 p.m. Eastern Time, the net asset value, meaning the total value of all the fund's assets minus its liabilities, is calculated. And step 3, the fund resets its leverage exposure so it's perfectly primed for the open of the very next trading day. Tomorrow is literally a brand new lifespan. Okay, part 4. Understanding the risks. Because treating this ETF like a machine means we rigorously have to understand its failure points. The prospectus is absolutely loaded with stark warnings, establishing right out of the gate that this is not a beginner's tool. They state plainly that Tradr ETFs are for sophisticated investors and professional traders with high conviction views. You really need to understand the risks of leverage, the crazy nuances of derivatives, and have the intent to actively monitor your position on a daily basis. Because of that daily reset mechanism we just went over, holding this for weeks or months could result in returns trending in the exact opposite direction of what you expect. The math compounds daily, right? So if the stock bounces up and down over a week, that constant recalibration creates a volatility drag that can severely erode the fund's value, even if the underlying stock ultimately trends downward over that longer period. And then we have to talk about the absolute worst-case scenario, 50%. The fund doesn't try to position its portfolio to protect you from maximum losses on a given day. So if Applied Optoelectronics moves more than 50% in an adverse direction, meaning the stock suddenly jumps up by 50% or more in a single trading day, investors in this negative 2x ETF would lose all of their money. Boom. A total wipeout of your principal. Given these stark realities, let's move to Part 5, Rules for Sophisticated Traders. Because of these extreme risks, regulatory bodies step in with hard rules governing the broker-dealers who offer the AAOZ ETF. A NASDAQ information circular issued to head traders and compliance officers back on July 15, 2026, visually signals a shift to strict guidelines on who should actually be allowed to trade this product. Brokers literally have a mandate to confirm an investor actually understands these complex derivatives and can handle the sheer volatility before recommending a trade. They must conduct adequate due diligence, satisfy strict know your customer obligations under NASDAQ Rule 2111A, and perform a customer-specific suitability analysis. Crucially, they are required to provide a totally balanced disclosure of both the risks and the rewards to retail investors. The bottom line we must objectively emphasize here is that there are absolutely zero guarantees in this high-wire act of inverse leverage. Even the fund itself explicitly states there is no assurance it will achieve its daily investment objective. Possible loss of principal is very real. It is a highly specialized, fast-moving tool with absolutely no safety nets. And that is the provocative reality of the daily leveraged ETF machine. It leaves us to weigh the extreme power against the extraordinary risk. If a single day can double your underlying position's movement or completely wipe out your principal, is the precision of a 2x short ETF a strategic masterstroke or just an ultimate gamble? Well, that's a question every sophisticated trader has to answer for themselves. Thanks for joining me on this explainer, and I really hope this helped demystify exactly how these complex instruments work under the hood.